This module focuses on two connected questions: how a business creates and sustains a competitive advantage, and whether the economics of one unit support a viable business model. In Learning Objective 3.6, I'll examine these ideas as part of business plan development and viability testing. The goal is to move beyond broad concepts and look closely at the value, costs, and underlying logic of a single unit of the business. That foundation helps determine whether the overall opportunity is economically sound. Today, I'll walk through four connected ideas that help turn a business concept into a disciplined decision. First, we'll identify the competitive advantage that makes the business difficult to copy. Then, we'll define the right unit and examine its true profitability through unit economics. Next, we'll use Yo-Yo to stress test a model before launch, rather than relying on assumptions. Finally, we'll bring those results together in a practical decision framework, so we can determine whether the opportunity is strong enough to move forward or should be reconsidered. Competitive advantage is the reason customers choose one company over every available alternative and continue coming back. It must be both unique and sustainable, because a temporary edge is not enough to support long-term profitability. The three core approaches are cost leadership, differentiation, and niche focus. Cost leadership means delivering comparable value at a lower price. Differentiation means offering something distinctive that competitors cannot easily copy. Niche focus means serving a specific customer segment more effectively than broad market competitors. Together, these approaches shape the company's value proposition and strategic position. A competitive advantage only matters if it can withstand pressure from competitors. The goal here is to evaluate whether your advantage is genuinely defensible rather than simply attractive on paper. Ask yourself, could a well-funded competitor replicate this in 12 months? If the answer is yes, then the advantage may not be strong enough to support your business plan. Use the four-part framework on this slide to examine your position honestly, identify where the moat is weak, and strengthen it before investing further. The economics of one unit, or EOU, is the most basic viability test for any business. It focuses on a single transaction and asks a simple but essential question: does a business make money on one sale? If the answer is no, increasing sales volume will not solve the underlying problem. In fact, scaling an unprofitable model simply multiplies the losses. Before thinking about growth, investment, or expansion, I need to confirm that each individual unit creates positive economics. That is a foundation for sustainable business performance. The first step is to define exactly what counts as one unit in your business. Precision here matters, because an unclear unit definition can distort every calculation that follows. For a product business, one unit is typically one item sold, such as a pair of shoes or a candle. For a service business, it could be one client engagement or one billable hour. And for a subscription business, one unit is generally one subscriber per month or per billing cycle. The right definition depends entirely on your business model. This step brings revenue and cost down to a per unit level, making the economics easier to evaluate. On the revenue side, start with the selling price, then subtract typical discounts and returns to find net revenue per unit. On the cost side, add direct materials, direct labor based on time and wage rate, and variable overhead such as packaging, shipping, and merchant fees. The key result is gross profit per unit, net revenue minus total variable cost. This shows what each sale contributes before other expenses. Now that we know the gross profit per unit, the next step is to express that amount as a percentage of the selling price. Gross profit margin equals gross profit per unit divided by selling price per unit, multiplied by 100. This percentage makes it easier to compare performance across products and against industry benchmarks. A healthy margin depends on the business model. Retail often targets 40 to 60%. SaaS businesses may exceed 70%, while manufacturing commonly falls between 30 and 40%. This worked example shows how Yo-Yo applies to a single candle. The $28 selling price is reduced by materials, direct labor, packaging, and payment processing for total variable costs of $12.09. That leaves $15. 91 in gross profit per unit, or a 56.8% gross margin. In practical terms, each candle contributes nearly $16 toward fixed costs, such as rent or software, and toward net profit. The key takeaway is that the unit model appears viable, with meaningful room between the selling price and the costs that rise with each sale. This slide connects the economics of each unit to the overall viability of the business. Gross profit per unit must eventually cover fixed costs, including rent, salaries, software, and insurance. The break-even volume is the minimum number of sales required to become profitable. The key test is whether that volume is realistic for the target market. If it would require an implausibly large customer base, the model needs another look, most likely through pricing or a more efficient cost structure. That's how we move from EOU to full viability. This is where strategy becomes measurable. Your competitive advantage directly shapes unit economics. Differentiation can support premium pricing and stronger margins, while cost leadership reduces variable costs. Define your unit. Calculate revenue, costs, and gross profit, then use break-even analysis to test long-term viability.